Okay, so I just uploaded everything or posted it to Google Classroom this morning. So today we're going to do the stock market intro notes that are here. Then you have a form that is your homework tonight. Tomorrow we're going to do a stock market simulation, which is this one. Then you will do your own thing, the student example of it. And then more stock market on Wednesday with the math for the math part of it. And then we'll start chapter 11 on Thursday. Friday is your quiz. It will not have chapter 11 on it. It's the stock market stuff. So going to your assignments for the week. Tonight is a Google form. This is tomorrow, Wednesday. This is for the week, kind of all of your notes. So you should be taking notes today. You will also take notes on Wednesday and on Thursday, and those will go in one, and then chapter 11, section 1 also. All of that is due Friday by 3 p.m. as well as your quiz. All right, so stock market basics or stock market intro notes, whatever you want to title it. This is where we are jumping in today. Okay. So portfolio diversity. So your portfolio, and some of these are repetitive and you don't necessarily need everything because some of this we already did in chapter 10. This is an outside resource, so it's part of chapters 10 and 11 with some extra stuff in it. But the portfolio is all the stocks, bonds, mutual funds, etc. you're investing in, and you want it to be diversified. So you don't want all of your money in one or two companies and not all in the same type of company. So we talked about industry risk, like if housing goes down and you're in lumber, all of your stock is in lumber, that's not good. You don't want all of your stock in oil. You don't want all of them in tech. You also don't want all of them in one or two companies. So this portfolio is not diverse because as you can see there, company number 3 is a big portion of this portfolio. This is diverse. You can see it's just more evenly spread out. All right. Okay. So why is it important? So if the stock goes down in one industry, you're not going to lose everything. Your other investments will hopefully balance the loss. So if all of your eggs are in the technology basket, you could lose it all if a new technology changes the market. Even large, safe companies can drop stock for seemingly insignificant reasons. For example, in 2005, eBay dropped 20% when it missed Wall Street expectations by 1 penny. It was 1 penny short, and the stock price dropped 20%. Over diversification can also drop your profits because it can be hard to keep track of too many investments. You want to kind of try to find the happy medium in there. All right. So securities are a type of financial instrument often used to raise capital. So all of these are types of securities. Diversity also means that you're investing in different types of securities. So it's not just saying you have 10 different kinds of stock in 10 different markets or 5 different markets, 10 different companies. It's that you have different types of securities. So stocks are ownership in a corporation. They represent a claim on part of the corporation's assets and earnings. Bonds are money you loan to a corporation or government, and then they pay you back with interest. And then the funds are a pool of money set aside for a specific purpose. So there's index funds, mutual funds, ETFs, or exchange traded funds. So again, you want to have different types of securities. This is a short video kind of explaining the difference between these three as well. So if you didn't get all this, we can come back, or you might catch it in the video.
Hi, my name is Sarah Glakis, and I'm with InvestingAnswers.com. Today, we're going to talk about some pretty important information you need before you start investing, and that is the difference between stocks, bonds, and funds. Let's start with stocks, a word you've probably heard before. A stock is simply an ownership interest in a company. So, if there's a company out there that you've always dreamed of owning, you can go into the stock market, buy one share of stock, and you're an owner. Investing in individual stocks is great for some people, but it tends to be a little bit risky. Stock prices fluctuate from day to day, and they can fluctuate by a lot. So you could buy a stock today for $100, and by tomorrow, for reasons that you might not even understand, the price could go down to $90 or lower. So, if you want to start with something a little safer, bonds may be the answer. Bonds are much safer than stocks because a bond is like an IOU. You're lending a company money, and it's promising to pay you back plus interest. That promise, which is legally binding, makes bonds a lot safer than stocks. But for most people, the most important investment term to understand is funds. If you have only one investment, it will most likely be a fund. A fund is simply a collection of stocks, or a collection of bonds, or even a collection of stocks and bonds together. Instead of buying just one stock or one bond, you can buy a fund that holds a basket of many different stocks or many different bonds. It's the ultimate in one-stop shopping. There are three main types of funds: index funds, mutual funds, and exchange-traded funds. An index fund tracks an index like the S&P 500. The index fund simply buys all the stocks that make up the index. For example, an S&P 500 index fund will buy all 500 stocks that are in the S&P 500. If the S&P 500 index goes up, the S&P 500 index fund will go up too. Mutual funds usually try to do even better than an index fund. A mutual fund manager tries to buy stocks that will outperform and sell stocks that will underperform. If the fund manager makes the right choices, your mutual fund will do better than an index fund. But if the fund manager makes the wrong choices, your fund will do worse. That's the risk you take when you buy an actively managed mutual fund. Finally, there are special funds called ETFs, which stands for exchange traded funds. ETFs are very similar to mutual funds and index funds, but they trade like stocks and they have slightly different tax rules. Ask your tax professional for more information. Thanks for spending time with us at Investing Answers. For more investing definitions.
Okay. So hopefully that gave a little bit of a better idea than just me saying it. There's also one on mutual funds coming up. So a mutual fund is a type of fund, but it's a professionally managed group of stocks and bonds bought using a pool of money from many investors. The net average value is the per share value of a mutual fund. So how much is it per share? Assets under management is the market value of the assets in the mutual fund, and assets under management fee is the fee structures vary, but it's usually a percentage of the assets under the management. So there's not usually a set fee, but rather a percentage to determine the fee amount. So you can see that little picture. It's kind of hard to see, but mutual funds, it says, what are they? So there's investors, they put their pool of money into the mutual fund, and then somebody who manages it invests it into stocks and bonds. They get returns, that goes back to you. And then ideally, they're hoping you invest again. with your profits. So some of the benefits of mutual funds, the affordability, diversification, so you have your money kind of spread out, liquidity, and professionally managed. So you might not be able to afford like your own share of Google stock, but maybe a mutual fund has Google in it, and so you have part of a share. So if Google does well, then your money would go up also. Just thinking of one that's kind of pricey. All right, and then this is a short 2-minute clip on mutual funds.
What are mutual funds? Presented by WallStreetSurvivor.com. A mutual fund is a collection of stocks, bonds, cash, and other securities that are managed by a professional. Generally, people buy mutual funds because they want a simple way to invest in a diversified portfolio with the security of knowing that someone will be watching it. Here's an example of how a mutual fund works. Here's Will. Will has been investing for a long time with consistently awesome returns. People are always asking him for investment tips and financial advice. So Will decides to start a fund where he will manage and invest for people. He registers with the authorities, gets the approval, and sets up a mutual fund. He calls it Will's Fund. Because Will is such an awesome investor, he is able to convince 10 people to invest $1,000 in Will's fund. Each investor owns one share of Will's mutual fund. Each share is worth $1,000. This is referred to as net average value. With the cash, Will invests in some stocks and bonds and leaves a little left over in cash. This portfolio is referred to as his assets under management. Will also takes a small percentage of the fund as his fee. This is called the asset under management fee. Let's fast forward 3 months. Will has made some really wise stock decisions. He was able to grow the portfolio from $10,000 to $11,000. Because he made an additional $1,000 and he has 10 shareholders, each of Will's friends will make $100, bringing the net average value of the mutual fund to $1,100. Will's fund is an example of a close-ended fund. He raised the money for his fund through his friends and is not accepting any more funds from outsiders. If one of his friends wants to sell their position, they would have to trade it to another investor. Mutual funds are traded on the stock exchange. To learn more about mutual funds, check out the Learn Center at WallStreetSurvivor.com.
Okay, so that's on mutual funds. Hopefully that gives you a little better visual of some of how those definitions kind of come into play. So the stock market is a collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. So you can see this is for Tesla. This right here in the box, TSLA, in red there, that's their ticker, their kind of abbreviation. So you can see from this example, on August 18th, one share, $18.88 that went up $52, which was 2.89%. And if you look at kind of what happened to their stock, you can see it was kind of holding steady right under $500, and then towards close to when 2020 happened, it kind of took a big jump. So that's just kind of a little snapshot, as well as these ones are as well. So it's kind of hard to see, but in the box it gives the ticket. And the first few letters, that tells you what stock market it is on, what exchange it is on. So there are multiple exchanges. And when I first started teaching finance, I did not know that. But this first one, the New York Stock Exchange, which we're going to talk about that next, NASDAQ, OTC, MKTS, that's over the counter. So that's where it's not as, so getting your stock on the stock market is difficult. You have to meet certain requirements and fees and everything. But the over-the-counter group here is not as strict. So it's easier to kind of get in there. And then this one, KRX, this is a Korean stock market. So Samsung Electronics is on the Korean stock market, which you can see here is a different currency as well. This is not dollars. So the New York Stock Exchange is a stock exchange in New York City that is the largest equities-based exchange in the world. It's stodgier, but a safer reputation. So stodgy, do you guys know what that means? I had to look it up before. It's dull and uninspired. So it still uses a large trading floor at 11 Wall Street in Manhattan in brokers and specialist trading system. I am not sure how that worked with COVID. I know that the trading floor was empty for a while. I meant to go back and look that up and totally forgot. But it's the thing you would see, you maybe have seen in like older movies where it's kind of a bunch of people crowded around yelling at each other. That's the New York Stock Exchange, where the NASDAQ is an electronic exchange with no physical trading floor and uses automated computer networks to make the trades. It's a high-tech exchange reputation. I think, I just want to look real quick at our book. I think our book goes into this a little bit more. Okay. This, I don't know why this video links a little bit differently. Hold on.
What is the difference between NYSE and NASDAQ? NYSE stands for the New York Stock Exchange, while NASDAQ stands for National Association of Security Dealers Automated Quotations. Both are well known in the trading sector for providing high-end stock trading platforms. The NYSE leads the stock market in market capitalization, while the NASDAQ is the leader when it comes to market share and the sheer volume traded. In the NYSE, the buyers and sellers trade physically by comparing bid prices and ask prices. In NASDAQ, the buyers and sellers transact through a dealer. In NYSE, the company must have issued a minimum of 1,100,000 shares to 400 shareholders at least. In NASDAQ, the company must have publicly traded at least 1,250,000 shares with a minimum bid price of $4. In NYSE, the market value of the company's public shares must be a minimum of $14 million, with $4 being the minimum share price. In NASDAQ, the company must have a minimum of 3 dealers for its stocks. The entry fee for a company to be listed on the NYSE goes up to $250,000. The entry fee for a company to be listed on the NASDAQ is from $50,000 to $75,000. And if you want to find out more,
Okay, so no, you don't need to know any of those numbers or anything. What slide were we on? But it's just how I wanted you to see. So that's why going back here, there's kind of over the market. So if they don't meet some of those listing requirements, that's why there's this over the market where they don't kind of fall under your other exchanges. Okay. But that just gives you an idea. Again, New York Stock Exchange is an auction market where buyers and sellers are kind of making bids. And then the NASDAQ is a dealer market. So there's no brokers involved there. All right, the market index is a hypothetical portfolio of investment holdings that represent all or segments of the market. So it's watched as a good indicator of how the segment or the market as a whole is doing. And you can't buy stocks in them, but you can buy index funds that track them. So as we saw in one of those videos about like the S&P index for the S&P 500, you can buy an index fund in S&P that is the overall that tracks it. And then an index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. Okay, so there's a link down here also I want to go to. But so the Dow Jones Industrial, these just might be some of the things you've heard, is a market index that tracks stocks from 30 of the biggest companies, most of which are traded on the New York Stock Exchange. Where the NASDAQ Composite is a market index that tracks about 4,000 stocks that are listed on the NASDAQ exchange. So possibly if you've listened to anything on TV about financial, you may have heard some of these terms. The Dow Jones, often referred to as Dow or S&P, NASDAQ. Oops, I want to go back. I don't know. That apparently did not link. All right, we'll just go here and link it ourselves. It's short, 1 minute, 9 seconds.
What's the difference between the Dow and the NASDAQ? The way people throw around the words Dow and NASDAQ makes them seem synonymous with the market, but there are important differences. The Dow refers to the Dow Jones Industrial Average, which is a key index that indicates how the stock market is performing. The NASDAQ can refer to the National Association of Securities Dealers Automated Quotation System, which is a global electronic marketplace where investors buy and sell securities. It can also refer to the NASDAQ Composite Index, which measures the performance of a portion of the stock market as well. The Dow and the NASDAQ both refer to an index or an average that's calculated from the performance of certain stocks. The Dow tracks stocks from 30 of the biggest companies in their respective industries, most of which trade on the New York Stock Exchange. The NASDAQ tracks about 4,000 stocks that are listed on the NASDAQ exchange. Investors cannot trade the Dow or NASDAQ, but they can buy index funds or ETFs that track either one.
Okay, so again, you can buy funds in these, an index fund, and they're averages. So if you hear this is how Dow Jones did, it gives you a kind of snapshot of those 30 biggest companies, which could be an indicator of how overall the stock market is doing. And then these last few are going to be some of what we've already been talking about. So supply and demand. So supply is the amount of a good or service offered for sale. So if you already have this and know this, you don't need to write this down again. If it helps you, please do. And demand is the desire of purchasers, consumers, clients, employers, etc., for a particular commodity, service, or other item. So supply, how much is out there? Demand, how much is it wanted? And the equilibrium is a situation in which supply and demand are matched and prices are stable. So kind of where are they meeting in the middle? Where are prices staying stable? They're not skyrocketing, they're not falling. So if the supply of the good goes up, what happens to the market price? So again, supply goes up. Then the price is going to fall. There's too many in stock, so too few customers. If supply goes down, then the price is going to go up. So there's not enough in stock, creates a higher demand from the customers. And then if the demand of the good goes up, we want to know what happens to the market price. So demand is going up, more people want it. So the price is going to go up. There's not enough, so then the whoever makes it says, oh, well, we can raise the price. They're willing to pay more. If demand goes down, though, then the price is going to go down as the customers buy less. They have an overstock in it, and so the price is going to fall to try to get people to buy it. So again, we want to try to kind of find that equilibrium right in the middle. So what causes stock prices to rise and fall? And we've talked about some of this. Prices rise if there's an increase in profits, or they fall if there's a decrease in profits. Signing a new client causes them to rise, and loss of clients or accounts cause them to fall. If there's a new product on the market, that makes them rise. But if a product fails or is stagnant, then the price will fall. Political, economic, and social events that indirectly affect the company positively can help prices rise. So like from the example last week, if there's a housing, if new housing is going well and more houses are being built and you have stocks in lumber, then your prices will rise. Where on the other side, if those events indirectly affect the company, it could be negative. If more people are choosing to invest, prices rise, or on the flip side, they fall if less people choose to invest for fear of the dropping economy. Hype, internet chatter, reports, articles, etc. That publicity, that makes the prices rise. But negative press or publicity can make the prices fall. This we've already talked about. This was on your chapter 10 test. The risk return trade-off, the relationship between the amount of risk taken in an investment and the level of return that is possible. So remember, the higher risk, the higher the possible return. The lower the risk, the lower the possible return. Bear and bull market. Again, we've already done these definitions. Bear market is a market in which prices are falling, which often encourages selling. And a bull market prices are rising or going up, encouraging buying.
Being bullish or bearish in finance means that you are either optimistic or pessimistic about the current market climate. Bulls are people who think the market or a particular stock is going to rise. If investors are bullish about a stock, they'll rally behind that stock by investing in it. Bears, on the other hand, are individuals who feel that the market and/or an individual security is going to lose value. Bearish investors will sell or take a short position in the security or index that they believe is doomed. Generally, investors shift in and out of bearish and bullish modes based on many factors, including global economic concerns, national economic data, and corporate financial performance. These two diverse outlooks create the market. To have a working system, we need people willing to buy and people willing to sell. Since bears often think the market or their positions are going to lose value, they will sell to mitigate losses. Bulls, on the other hand, will perceive the same economic indicators as a good time to buy, and they'll pick up what bears are selling so that they can profit from the upward momentum that's anticipated. An investor can be bullish about the overall market, but bearish on a given stock. In this case, a proper trading strategy would be to take a short position in the stock and buy a market portfolio or an instrument that tracks the market. The opposite situation can be true as well. So while these iconic animals of Wall Street consistently take opposed views on the market, wise investors know that both mindsets are needed for successful trading.
All right. So that slideshow is on Google Classroom for you guys. This first assignment here, the stock market intro homework, is a Google form that is all about what we did